let's say you could make this payment, the 15-year payment, and you're making it month after month after month, and then some hardship happens. Wouldn't it be nice to be able to drop down to the $29.35 and make that payment until you regain a job or your situation changes and you can go back to this payment? That's what I'm going to show you today. You can look at finances much different than what the banker's telling you or the real estate person's telling you, and do what's best for you so that you can cover and make sure that you and your family are taken care of in bad times. This is something I wish I would have done. I wish in the past, instead of changing from a 30-year mortgage to a 15, that I would have just kept my 30-year. Now let me explain something. This is very important for people to understand. Most of the mortgages that you go to get, it's going to be typically your 30-year mortgage. That's what most people look at. And then there's the 15-year mortgage, which is essentially exactly the same, but it's just being paid off in 15 years. Then, of course, there's all these different things, whether it be an ARM or whatever it may be. But conventional is 30-year and a 15. Now, you say to yourself, okay, well, I want to get a 15-year mortgage because I want to pay it off in 15 years. Now, you're going to have a higher monthly payment, but you typically have a lower interest rate. So if the bank knows you're paying it off in 30 years instead of 15, let's say the 30-year in this example is right now at 8% rate, and the 15-year happens to be a 7.15. So you get a 15-year, you're going to have lower interest payment. So I'm going to walk you through what all that means, but let me tell you why I would do this. If you want to pay it off in 15 years, you're saying to yourself, I want to pay it off faster. But what are you giving up? What's happening? Well, you have a higher monthly payment. So in this example, a 30-year at 8% is $2,935, almost $3,000. A 15-year at 7.15 is $3,628. Okay, so that's a difference of $693. So you want to pay it off faster, and I'll show you the benefits of that. However, this is an insurance policy. It's your own personal insurance policy. We all know that economies go up, economies go down. In a family, you might have hardship, someone might lose a job, you might have multiple incomes, one of those may go away. So you want to know on a monthly basis exactly how much you have to pay every month so that you don't miss your payments. In other words, if you have a mortgage payment, obviously you want to make that even in hard times. You have a car payment, electricity, heat, food, and other things you can get rid of in bad times. If you're paying someone to cut your grass, you can do it yourself. If you're paying for all these streaming services, you can turn them all off. But you don't want to not eat. You don't want to not pay your mortgage. You don't want to not make that car payment. You got to put gas in the car. So there's a minimum every month that you have to pay. So it's best, in my opinion, if that is as low as possible. How do you keep it low? Well, a 30-year mortgage is an almost $3,000 a month at the moment. Forget the interest rates at the moment. They're going to change based on when you're watching this video. It happens to be November of 2023. These are essentially the going rates. $3,000 a month. In a 15 years, $3,628. Okay, that's a difference of almost $700. So if you had some financial issues at home and all of a sudden you had less income, wouldn't you rather pay $3,000 a month for your mortgage as opposed to $3,600? Well, of course you would. But if you've gotten a 15-year mortgage, you must make that payment or you're not meeting the terms of the mortgage and you can lose your home. So how can you pay it off faster but not get the 15-year mortgage and be locked into that payment, right? Let's say you could make this payment, the 15-year payment, and you're making it month after month after month, and then some hardship happens. Wouldn't it be nice to be able to drop down to the $29.35 and make that payment until you regain a job or your situation changes and you can go back to this payment? That's what I'm going to show you today. So let me walk you through this. 30-year mortgage at 8%, we're showing $29.35. This is on a $400,000 home. So in all three of these, I've got three examples here to compare. The home is $400,000. I use that price because it looked like that was the median or average across the United States. Median and average are different. I can't remember which one it was. Maybe it was a median. But $400,000 home. Okay, so what does this mean? Now, you're going to pay over 30 years at 8%, $656,000 in interest. So the total cost will be over $1 million, $1,056,621. On the 15-year, it's 7.15%, so it's a lower interest payment over a shorter period of time. Yes, your payment's higher, but look at the interest on the same home. $253,000. You're not paying $656,000 in interest, you're paying $253,000. So your total cost is $653,000. So why do people get a 15-year instead of a 30? Because in this case, you would save $400,000. That is obviously significant, and that's why you're going to want to do it. Now, here's just a caveat of something that drives me crazy. People will say, oh, what'd you pay for your house? Oh, what'd you pay for your house? What'd you pay for your house? And they think that if they all got a mortgage and they're having a discussion, what really matters is the interest rate and the term, not so much the price. Of course, the price matters because it depends, if you want to sell your house in the future, you don't want to overpay for something. So obviously negotiate the lowest price you can. That goes without saying. But someone might say, oh, well, I paid $400 and you paid $410. Well, if one of them got a 30-year and one of them got a 15, at the end of the day, look at the difference in cost. If this person got a 30-year mortgage on a $400,000 home, it's going to cost them $1 million. If I went and paid cash for a $400,000 home, it's going to cost me $400,000. They're not the same. Heck, I could pay $450,000 cash, and I'm still paying less than that person. So just understand that the price of the home is one thing, but over time, there is a total cost of the home, and that's why mortgage rates matter, and that's why terms matter.
Thanks for watching. Take a moment to hit that subscribe button so you don't miss future videos, and hit that like button as well. It really helps the channel out and helps the video spread to more people. Thanks for watching.
Okay, so what was I getting at earlier? The point that $2,935 is the cost here, and $3,628, and you're saying, well, wow, I want to pay it off in 15 years for various reasons. One of them is I want to save $400,000, so I'm going to get the 15-year. But again, the idea that I'm showing you is that insurance policy of what if you want to be able to drop down. So how can you get a 30-year mortgage but pay it off as if it's a 15? Simple. You make your payment of $2,935 every month, and you add an additional $693, which is the difference between these two payments. So you're basically paying it off as if it's a 15-year so you're making a payment of $3,628 on a 30-year mortgage. So everything over the $2,935 goes direct to your principal. So the payment you make when they say, here's your monthly payment, as you know, whether it be a credit card or a mortgage, whatever it is, if you're accruing interest, part of it goes to pay down the principal, making this number lower. Part of it's just interest and goes right to the bank. So part pays this down, part pays this down. Well, when you pay more than that payment, whatever that number is, in this case, we're doing $693, which is the difference between these two. That $693 goes directly to pay down the house. This is what you care about. Pay down my house. This money goes to the bank and they all buy boats and cars and have a great time. This number you don't care about. So the more you can pay over, the faster you're going to pay down that principal, and it's going to change the length of the loan. A 30-year loan is 360 months. A 15-year loan is 180 months, right? 30 years, 15 years, simple. But we want to be able to go ahead and get a 30-year. For example, you may not have been able to qualify for a 15-year, but you still want to pay it down as if it's a 15-year. You can do that. You get the 30-year, you increase the payment by the difference, and you can see that the payment's still $3,628. Now, here's the caveat. It's not going to be perfect, but I'll show you what I mean by that. $400,000 home, you're going to pay over time $325,000. Now you're going to say, well, wait a second. The 15-year paid off at $653 total, and it was $253,000 in interest. This one's $325,000. This is not as good, and that's true. The math isn't perfect. So let's look at the differences in what you're giving up. What are you getting? You're getting your own insurance policy that says if things go bad, you can drop your payment down and you won't be in default. As long as things are good, you make extra principal payments, you can pay it off faster. If we just use the difference in this case of adding 693, you could add more if you're able to. You're going to end up, and let's look at these differences, 30 years, $1 million total. 15 years, $653,000. 30 year plus the extra payment, as if it's a 15, is $725. So it's not as good as 653, but it's still way off $1 million. So in this example, you were saving $400,000. With this, you're going to save $331,000. And it's going to take you 200 months. So 360 months, 180, 200. So in this case, by adding that extra principal, the difference, it's going to take you 200 months, not 180. So it's going to take you a little longer. And you're not going to save 400, you're going to save 330. You're not going to save quite as much. I look at that as an insurance premium payment. So you may want to do this, you may not want to do this. I like to be able to keep my monthly expenses that I must pay out as low as possible. So I do the 30 year, but I add extra principal to pay it down faster. So my recommendation, if you want to consider this, is that you see the price range of a home that you can afford. If you want to only put 20% towards a mortgage payment or 30%, they do a mathematical calculation when they approve you, but it's up to you as to how much you want to put towards a mortgage every month. And so you determine what you want to put, and then you run it through a calculator for a 15-year mortgage, and you say, well, can I make that payment? If I can, great. I'm going to get the 30-year, knowing I can add the principal. So in the calculator, in the description, you'll see, and I'll put it up here just briefly so you'll see how it works. You put in the length of the mortgage, how many years, you put in the percent, you put in the dollar value of the home, and then there's a spot where you can put in the additional principal, however much you want to add. Hit the button. It'll show you exactly how much you save. It'll show you the total price of the house, how much you save, how much you're paying in interest, and then it'll show you, as you scroll down, every monthly payment, it'll show you how many months. So you can take this 30 year, and by adding additional payment, you'll be able to move a 360 months to 300 months, or 360 to 280, or 360 to 180, or 360 to 10, whatever it may be, depending upon how much extra you're willing to pay down.
In the description will be a link to this calculator. You can scroll down here and read the instructions. It's fairly straightforward. We'll use the same example that's here in the video of a $400,000 home, a 30-year mortgage, 8% interest, and in this case, we're adding an amount of principal every month to the payment. You hit calculate, and here's what it's going to do for you. It just goes through your typical mortgage. It's not putting in taxes and those other costs associated. It's just the mortgage amount. So you can see here, it's going to show you the monthly payment on a $400,000, 30 years, 8% is $2,935 a month. Just like in our example, we added $693 because that's what it would be if we made a 15-year payment. So with a 15-year, in other words, it's saying with the extra amount of $693, your payment's $3628. It just took the $2935, added the $3628. Now, with no extra, without the extra payment here, it would be over $1 million to pay off the home. By making this additional every month, it comes out to $725. So you can see the difference here is around $300,000. Then how much interest would you have paid if you didn't make that payment? You would have paid $656,000 in interest. But since we're making the extra payment, we are only going to pay $325,000. And as you scroll down, it goes through every single month. The first month of your payment, it's $961 to principal, $2,666. Now this is with the extra amount. Your remaining balance, $399. Each month it tells you how much goes to principal, how much to interest as the months go on. You scroll down. Now a 30-year mortgage is 360 months, but you'll see here that it's only 200 months because we made that additional payment. Real easy to use. Just type in the amount of the mortgage, put in the number of years, the interest rate, and how much you want to make additional. For example, if you were to say 0 additional, as you can see, the monthly payments are the same, the total amount paid, and interest. So click that link, take a look. and put in your mortgage that you currently have or one you're contemplating and see how much you can add in additional monthly payments to see how much faster you can pay it down.
So the whole point of this video, what I want you to understand, is to think about your finances completely different than everyone else. Think about, obviously, good times, but also consider the bad times. You know, there's many people out there. I love watching some of their different channels and shows where they'll say things like, keep 3 months of money, of cash in the bank to pay your expenses, or keep 6 months to pay your expenses, right? Why are they saying that? Because they're saying there may be times where things go bad. You don't want to have $0 in the bank. If it takes you 3 months to find a new job, you still want to be able to make your payments. Great. So when you keep that money in the bank, which makes perfect sense, wouldn't you like to have your monthly amount that goes out the door? If it's normally $3,000, what if it was $2,000? Or if it was $2,000, what if it was $1,500? So that's what this does. You're going to make that additional principal payment. You're going to pay it down faster. Not quite as fast as a 15-year if you're just using the differential, but you can add more principal if you want to pay it down faster. But essentially, if you just keep the payment what a 15-year would have been on the house you're buying, then it's going to not quite cut it to 15 years. It might be 16 and a half years. But that's sort of that insurance premium you're paying so that if things go bad, you don't have to make that $29.35. I'm sorry, you don't have to make the $36.28. You're making the $29.35. I know this from personal experience because I did it and I wish I hadn't. I said to myself, well, I want to pay 30, instead of a 30-year mortgage, I want to pay mine off in 15 years. So this was a previous home. I refinanced it to the 15-year. I was like, great. I wasn't thinking, well, heck, I can just make a larger payment every month and pay down principal. I got the 15-year, then had some financial issues, and I really wished at the time that I could drop my payment down. I really wish I had that 30-year, but I didn't, and I was stuck with that payment, and it made life more difficult than it needed to be. So I hope this is helpful. Take a look at the calculator, plug in the numbers, rewatch this if you need to, ask questions in the comments, but consider that extra, if you will, insurance premium of getting a 30, but paying it as if it's a 15. So you pay it down faster, but you also have the ability to lower your monthly payment if you need to. I hope this is helpful, and I hope you're learning that you can look at finances much different than what the banker's telling you or the real estate person's telling you, and do what's best for you so that you can cover and make sure that you and your family are taken care of in bad times. I hope this is helpful in learning how to hack your finances. Thanks for watching.